What's good, everybody? In today's video, we're going to go over fair value gaps. We're going to go into what is a fair value gap, how to identify a fair value gap, consequent encroachments of a fair value gap, and inversion fair value gap. So let's start with what is a fair value gap. As we can see, a fair value gap in trading refers to a price range on a chart where buying and selling activity is unbalanced, often occur during a rapid price movement. As you can see in the illustration here, we're at a rapid price movement, right? This imbalance results in a gap or area on the charts with minimal or no trading activity. As you can see here, this is the gap where we had minimal to no trading activity, right? Which can then act as a magnet for price to return to later, as we can see. So, okay guys, now we're going to show you how you can actually identify a fair value gap. Now, how you identify it on the chart is when you see that the fact that it's a 3 candlestick formation. And in a bearish movement, if you see the first candlestick's low does not overlap the third candlestick's high, then you have a fair value gap. If wherever you see an instance where the candlesticks overlap, then it's not a fair value gap. And I can even show you here. If we bring this up here, you see what happened here? The first candlestick's low overlaps with the third candlestick high. This is not a fair value gap. But now if they don't overlap, that's a fair value gap, and you can mark it out as so, right? And that right there would be your fair value gap. And the same thing happens on the bullish side. If you have the first candlestick's high does not overlap the third candlestick's low, then you have a fair value gap. This isn't an imbalance. This is price inefficiency. Now let me go over to the charts and show you an example of such. Now we're here on the charts on the dollar CAD, and we're going to show you an example of a fair value gap. Now as you can see here, you have the 3 candlestick pattern. You have 1, 2, 3. The first candlestick's low does not overlap with the third candlestick's high. That space in between is the fair value gap. And what does price do? It trades into that fair value gap and it treats it as an entry or form of resistance, and then continues down in its downward trend. And you can see as price is going down, you can see here's another fair value gap. First candlestick's low does not overlap with the third candlestick's high. That space in between is a fair value gap. And we can see what price did. It raised up into that fair value gap and it treated it as resistance and then continued down. And we can see here one example of a bullish fair value gap where price was bullish and we left the fair value gap, price inefficiency. The first candlestick's high did not overlap with the third candlestick's low, leaving in a fair value gap in between. And what did price do? It traded right there and right there, treated as supports, and price continued up. Now we're going to in what is the consequent encroachment of a fair value gap. A consequent encroachment of a fair value gap is when you have a fair value gap that's created and we're trading back into the fair value gap, but instead of us trading all the way into it, we go into the 50% of the fair value gap. You can do so by using a Fibonacci, getting 50% of that fair value gap, which is right about here, right in the middle of that fair value gap. right there is consequent encroachment. And when price is bearish, you want to see the body of the candle not close above 50% of that fair value gap. If we close below it, that indicates bearish movements or momentum, and we move down. Same thing here. If we bullish, 50% of the fair value gap, right there, that is consequent encroachment of a fair value gap, and we trade down into it, consequent encroachments, the 50% of that fair value gap, and we move. And also, what I tend to see, because sometimes we can balance the fair value gap. By saying balanced, we trade it all the way down into the fair value gap, but the body, right, closes above 50% of that fair value gap. That right there can still validate a fair value gap and momentum for price to go up. And that right there, that's an inversion fair value gap. What we're going to do now is show you some examples of a fair value gap. As you can see, we have bearish momentum down, and right here we can see we had an inefficiency, a fair value gap right over here. We traded back into that fair value gap, and let's see if we had consequent encroachment. So what we do, 50% of that fair value gap, and you can use your Fibonacci. You can draw a line there, and what did we do? We had 50% of that fair value gap filled, and you can see the bodies of the candles, they did not close above 50% of that fair value gap, which showed us bearish momentum, and we went down. That is consequent encroachment of a fair value gap. And here's another example. Bearish, we left the fair value gap, we traded into the fair value gap. 50% of that fair value gap, right? We mark it just so you can see, and look at the bodies. The bodies of the candles are respecting 50% of that fair value gap, which is consequent encroachments of that fair value gap, showing us some bearish momentum. And what did we do? We went down. Price went down. And entered into another fair value gap. It creates another fair value gap. We entered in. We spiked. We wicked in. Spiked. Wicked in. Consequent encroachments of it. Down. Showing us heavy bearish momentum and validating the fair value gap. Yes, guys. And now I'm going to show you an inversion fair value gap. As you can see, we have our fair value gap created. This time we have a candlestick where the body closes above the fair value gap, which is not showing us bearish momentum. But now that fair value gap inverts and shows us a form of support to go the other direction. And what happens? Price will trade up, and as it comes down into this fair value gap, it will be treated as support. That's an inversion fair value gap, and then you'll see price bounce off and have forward momentum. And the opposite happens here. As you can see, we bullish, but now when the candle drops down into the fair value gap, the body closes below the fair value gap, and it becomes a inversion fair value gap, and now it's treated as resistance, and price will trade back up to that fair value gap, and it will be resistance, and it will bounce down in continuous motion to the downside. Now I'm going to show you some examples of the inversion fair value gap. As you can see, we have our fair value gap here, and as we traded up into that fair value gap, our candlestick closed above this fair value gap, and then next it changed into an inversion fair value gap. So as price traded up, we traded back down and was treated as support. And you can even see we had consequent encroachments of that inversion fair value gap, which supported a continued bullish momentum upwards and holding this fair value gap or inversion fair value gap as support. And what we do, we trade it up. And we have one more example over here. As you can see, we have what? A fair value gap right there. We traded into once, then we had a candlestick that came here, closed above this fair value gap. And what happens to the fair value gap after the close? It turns into an inversion. And when price traded down, it came and treated that fair value gap or inversion fair value gap as support. And what did price do? It traded up. And that's a quick summary of a fair value gap. So what did we go over today? We went to what is a fair value gap, how to identify a fair value gap, consequent encroachment of a fair value gap, and an inversion fair value gap. I hope that was some help, guys. I hope you guys have an eventful day and good trading.